This 3-step ICT strategy got me payouts like this, and this. And I'm about to show you exactly how. I've been trading for 14 years and have tested hundreds of complicated ICT strategies, and this is one of the only ICT strategies that works every day. Today, I'm going to teach you the full strategy, show you live trade examples, that way you have everything you need to finally become a successful trader. So first, we need to lay out the foundation of our trade and mark the key levels where we're going to look for opportunities. So to do this, we break this down into 2 key parts. First is going to be marking out the previous daily highs and lows. So when we are talking about our daily highs and lows, let's just say we have this specific block of price action, and this represents 24 hours of our trading day. Now I'm talking about midnight Eastern to midnight Eastern. Okay, so inside of this, we might have price action, right, intraday, that's creating what? A previous daily high and then our previous daily low. So we want to be able to understand what inside of this 24-hour window, what is the highest price and what is the lowest price. Okay, this gives us an idea of if we're trying to get long, maybe we're going to target the previous day's high, right, on that following day, or maybe for short, we're trying to target the previous day's low. Okay, very straightforward. Now, when it comes to areas of premium and discount, we're going to mark out what? Fair value gaps, order blocks, and maybe Fibonacci retracements. Okay, don't try and add too many things in here. You just want to try and keep things as simple as possible. Based off of these concepts, we have 3 different entry models, and to be honest, you don't even need these 2. You can get away with using only fair value gaps when you're trading. What I'm going to actually do is inside of this intraday price action, we're going to mark out any fair value gap. So we might have a bullish fair value gap that was broken up here, which created an inverted fair value gap. And then maybe in here, we have a bearish fair value gap in here. Okay, we're going to mark both of these out along with our previous day's high here. So we have our previous day's high and then our previous day's low. Okay, after marking out this price action, let's just say going into the following day, we have this divider here, which marks out our midnight. So after we've identified our key levels, again, this should only take you a couple minutes at the end of every day. So typically during like Asian session, or maybe even right before the market opens the following day, I'm sitting down in front of my charts and I'm very quickly just marking out previous day's highs, previous day's lows, and then any important levels that I'm trying to find intraday. So maybe there's a bullish fair value gap, maybe there's a bearish fair value gap. I just mark that out intraday so I know what I'm looking at for that following day. All right, now we've got all our levels marked, which is great. However, knowing where we want to take trades is totally useless if we don't know when we want to trade. So when we're mapping out our trade, we have to do a couple things. We have to understand the calendar, and this is going to allow us to time our trade properly. Also, how to avoid poor setups. So I'll get into that bit in just a minute. But when we're studying a calendar, let's just say I'm bearish on this specific day because we've broken market structure down here. So when I look at this intraday market, yes, it's very sideways, but we get a strong displacement towards the end of the day. What I'm anticipating the following day, however, let's say this market closed bearish on the day, I'm looking for continued bearish price action the following day. Now, based on the calendar, maybe we have a high impact news event around the open, or maybe we don't have any news at all. In both cases though, what I'm anticipating though is for the following day for the market to trade higher into some level of premium. Maybe it's going to trade into this bearish fair value gap, or maybe it's going to trade into this inverted fair value gap all the way up here. But what needs to happen is this market up here needs to align with the time that I'm trying to trade. So let's say, for example, we have a high impact news event in New York, but this is London session. Okay, am I inclined to take this short just because it's inside of a bearish fair value gap? Or should I be waiting for the news event? Maybe they're going to manipulate the market higher. Okay, this is really where I want to take the trade and not in here. So I'm going to walk you guys through a very clear example of steps 1 and 2. So here we have a chart of NASDAQ, and this is really just an hourly chart. A lot of my analysis is coming from the daily, the 4-hour, the 1-hour, because I'm trading off of these higher time frame levels. I am only using the low time frame to time my entries. All right, but all of my analysis and what I'm looking for in the charts is really derived from these higher time frames. So what I'm anticipating, okay, so let's say Friday was bearish and maybe Monday we have a news event, or I'm just waiting for the market open. What am I going to anticipate leading up into that open? So what I'm anticipating is this market to slowly trade higher, okay, into this fair value gap right at the open, okay, hopefully not taking out the previous day's high because that would kind of shift market structure. And then I can possibly position myself short to target what? Previous day's lows. Okay, so this is what I'm anticipating the following day, and this is how I'm mapping out my trade. So you guys can see here that I have this fair value gap plotted, but I also have this inverted fair value gap plotted. So I have both of these intraday levels marked out, and this is really just so I can identify some of the levels where we might trade to or where we're going to have some issues getting through. So let's play this market forward. And again, when I'm trying to map out my trade, I'm trying to get short at a premium and maybe near the previous day's high, but the time has to align. So I am waiting for the equity open. So let's play this market forward and just anticipate what's going to happen next. So we are now inside of this inverted fair value gap. Again, it's not at a level that I'm trying to short. Okay, what I'm looking for is the market to trade higher here as a manipulation ahead of the open. Now you can see that from a timing perspective, if I'm trying to be bearish on the market, this just doesn't make any sense. All right, if I'm trying to be bearish, I don't want to see London pushing lower. I actually want to see it manipulating higher so I can position myself properly. Okay, now this is exactly where I'm interested in the market. Okay, it's traded up into this fair value gap and it's given us a bearish engulfing candle. All right, so if I mapped out a bearish trade, again, I'm not going to trade short into this inverted fair value gap. That just doesn't make any sense. I'm waiting for a premium level. Right? We get very, very close to our previous day's high. So shorting it up here probably would have been the best idea, but I'm actually waiting for the close here to kind of give me an indication that the market wants to roll over. So right at 10 a.m. is when I'm anticipating the market to go short. So let's say if I place a short position here and then I'm just targeting the previous day's low, and then we run this forward. So I'm planning out a roughly 2.4 to 1 risk to reward. All right, the market's coming back. It's going back to break even. It's moving a little bit slow. Now we have the market rollover. This is actually in the Asian session, and there we go. So this trade idea, right? We mapped it out. We were bearish on the day. We avoided taking the short in here, and we waited until this market got into a premium with a strong rejection. Now, yes, this takes some time for the market to actually trade in your favor, and if you're trading a futures prop firm, you would have had to close on the rollover, so you might have been up a tiny amount, but you can close that trade ahead of the close and just reopen it at 6 p.m. And as long as the market doesn't gap too heavily, you've essentially been in the same trade throughout the rollover period without breaking any of the rules. So this was a very straightforward trade. Again, identifying our key levels, which should only take us a couple minutes to do. We had this bearish fair value gap, then we have this inverted fair value gap here, and then we have our previous day's high and previous day's low. I'm really only interested if it trades to this level here. Our entry model is here with an engulfing candle. Basically, I just entered short on the open of the new candle, and then from there, it's just all a matter of patience. Now, this strategy is perfect for prop firms. If you're looking for a discount, I'll leave a link down in the description. So as I just showed you guys, very important to identify our key levels, our areas of premium and discount, where we're trying to get short or long, and then mapping out the trade, knowing when to actually position yourself. And when it comes to avoiding poor setups, let's just say you're bearish the next day, but the market really just drops lower. So for example, if I wanted to be bearish on this day, but the market just drops lower without me, essentially I don't have a trade. So going forward, let's say if we marked out this, all of these levels in here, and we had what? This fair value gap here. Okay, we have this fair value gap all the way up here. And these are the intraday levels that I'm expecting the market to trade higher to in order for me to get short. But instead, the market just drops without me. Well, what do? I don't take any trades. What I'm looking for is that run higher into those previous intraday levels before I get short. But if the market expands lower without me, I'm essentially just trying to chase markets and FOMO into them. So really, I need to be patient, waiting for this market to trade higher into my levels. And if it doesn't do that, guess what? I don't take any trades. Now, step 3 is the simplest part of the entire strategy, yet this is where most traders everything up and stay unprofitable. But after you see this simple approach, you'll never second guess yourself again. So this is really just going to be an analogy which I've shared before, but executing your trades as a professional, consistent trader is probably the hardest part about trading. Most people have a plan and they just don't execute their trading plan. They say that they want to be short the next day. They find themselves in a long. They say that they're going to risk 1% and find themselves risking 3%. And when it comes to executing your trading plan, a lot of it comes down to your emotional control. So if I go back to this specific trade idea, okay, if we went short here, think about how much mental turmoil I have to sit in before it actually starts moving in my favor. Okay, this is 1, 2, 3, 4, 5, 6, 7 hours of this market just trading around on me sideways and me battling the emotions that come up when I'm trying to manage the position. I see it go in profit a little bit. I see it come against me. All right, this is all about executing your trading plan. If I said I wanted to be short, just because the market goes sideways on me does not mean I just abandon the idea, because is, let's say if I abandon the idea and then all of a sudden the market just starts moving in my direction. That was me not following the plan. And when it comes down to your execution, basically it's just about doing what you say you're going to do. If you say you're going to be bearish the next day, do not go long if you're anticipating the market to go lower, just because of what you saw on the lower time frame. All right, the biggest problem with execution is that traders are just not confident enough in their analysis and their thought processes and their trading processes to be able to withstand the market fluctuations in order for them to take advantage of specific market moves when they go to their target. So let's just assume, for example, you have a target of 25K. And let's just say that this is in California, and then where we currently are is New York, and we want to buy a bus ticket to California. What happens is you're going to get on the bus in New York, and your destination is California. So let's just say that the market starts its journey towards California, but what happens is the bus driver gets really tired, and he says he needs to take a stop in Ohio. So what happens is maybe you're trailing your stop. All right, the bus driver takes a pit stop in Ohio, and stops you out. And he says, all right, everybody get off the bus. I am going to take a nap for 4 to 8 hours and get back on the bus, and then we're going to make our way to California. Now, this is where a lot of traders decide to not execute the plan. Okay, the plan was to get on the bus and go to California, but there was an unforeseen circumstance. So here we have two decisions to make. Do we get back on a bus because we don't trust that it's going to get to California and make our way back to New York? That's essentially you going against your bias and going long in the market because you don't trust that it's going to get to 25K. Whereas the person that is going to execute the plan when they got on the bus, okay, the person that got on the bus in New York is trying to execute a plan to get to California. Do I get short on the market again? Okay, so maybe there's another setup that shows up and they get short on the market again. Meanwhile, the person that's not confident in their analysis and their strategy, they get on a different bus and try and go in the opposite direction back to New York because they don't trust the bus driver. They don't trust that this bus driver is going to get them to California. What happens is the market eventually gets to California. Meanwhile, the person that wasn't confident is all the way back in New York, right? Now you're stuck in New York. Your bus that you were supposed to get on and stay on is all the way in California. And this is trading in a nutshell. You have to come into the markets with a plan and execute that plan. Yes, the market is going to make pit stops along the way. You can't control what the bus driver is going to do. This market, aka the bus driver, can take as many pit stops as it wants. But just because you got stopped out on one idea does not make this trade idea wrong. Eventually, if it gets to 25K target, you just have to anticipate that this bus might go on different routes to get there, which if it takes different routes, you are just not in control of it. So when it comes to executing your trading plan, you have to be comfortable with the uncertainties of the market. You can come in here and do all of this, identify your key levels, map out the trade, but the biggest problem that most traders face is when it comes time to execute their trading plan, they stumble. You can do some parts of this right, but on the way to the destination, you're making irrational decisions that are not aligned with your trading plan. And the biggest thing when it comes to executing your trading plan is you do exactly as you say. You now have a simple and proven strategy, but chances are you've had good strategies before, but still aren't profitable. I know this because I struggled for 10 years before I became profitable, which is why I created my mentorship. This is not your average trading Discord. It's direct access to me, a verified 7-figure trader, to teach you everything I've learned in the last 14 years. I'll leave a link to apply down in the description, but I want to be clear, I don't work with just anyone. If the link still works, there are slots left. Otherwise, you can join the waitlist. Thanks for watching. Make sure to subscribe, and I'll see you guys in the next video.